Hello, good morning everyone. Welcome back to my YouTube channel. My name is Onode Rogers. I want to really appreciate those who have subscribed to this channel, and if you know you have not done that, please kindly subscribe. So let's just take a quick recap on what we learned in our previous video, where we discussed the principles of double entry. The principle of double entry, where we say for every debit entry there must be a corresponding credit entry. That means simply put, debit the receiver and credit the giver. That means to say every transaction must have two accounts, must impact on two accounts. One of the accounts will be debited, the second one will have to be credited. I've also said that it is the double entry principle that ensures the balancing of the accounting equation. As we said in our previous video, today we're going to be looking at the subsidiary books of account and the source documents. Okay, so let's get started. Okay, so far we have looked at bookkeeping and accounting, then the principles of double entry. Then today we are going to be looking at the subsidiary books of accounts. The source document. All entries in the book must have documentary evidence. That means every transaction at all must have documentary evidence. The source document provides full information for the preparation of the books. The first one here we have the invoice. The invoice provides full detail of goods sent by the supplier to the buyer, stating the quantity, price, discount, and terms of payment. The next one we have the credit note. The credit note is also a document sent by the seller to the buyer to reduce the amount owed by him. That means you are sending it to the buyer, telling that, okay, you owe me 1,000 before, but we are reducing it by so and so amount because of so and so reason. You are reducing the indebtedness of the buyer to you. So let's look at credit notes received from the supplier. When credit notes relate to goods returned to supplier, it will be entered into the return outward book and the supplier's account. Now it is the buyer that is receiving the credit note from the supplier. Initially, the buyer created an account for the supplier, showing that he is owing the supplier so and so amount. But now that he has returned goods back to the supplier, and the supplier has supplied him with a credit note, he's going to debit the supplier's account and then credit the return outward book. But when credit note is issued to the customer, now in the book, this one to be in the book of the supplier. The supplier is going to enter this transaction into the return inward account by debiting the return inward account, show that he received the goods, then credits the customer's account, showing that they have reduced the buyer's indebtedness by so and so amount. So now let's look at the next one. We have the debit note. This is a document sent by the seller to the buyer to increase his indebtedness. If the credit note reduces the indebtedness of the buyer, but in the case of debit note, it increases the indebtedness of the buyer. This could be due to undercharge, or when goods are not charged on the invoice. Maybe probably they skip the summation is not correct, or let me say some of the item enter on the invoice initially they're not correct, or they were not calculated correctly. So they send in a debit note to the buyer to say, okay, so your so and so reason, your debt to us, the amount you're owing us no longer so and so amount, but so and so amount for so and so reason. So let's look at the next one. We'll look at the last one, the receipt. The receipt, when you go to buy goods in the supermarket or anywhere, they normally give you a receipt to show that you have paid for the goods you bought. So it's also a source document. Okay, now let's consider books of accounts. There are two books of accounts. We have the subsidiary books and the principal books, which is also the ledger. So these two books are very important in the recording of financial transactions. All transactions must pass through the books of account, that is the subsidiary book and the principal books. We are going to consider the subsidiary books of account in this section. So subsidiary books are books of original or prime entry. They are used to make first entry of financial transaction. That means when a transaction occurs, the first place to record the transaction is the subsidiary book of account. I mean, before any transaction finds its way to the ledger, it must go through the subsidiary book of account. And also note that the subsidiary book of account do not form part of the double entry principle. That we don't apply the double entry principle in the subsidiary book of account. We just merely record the transaction the way they happen. So why subsidiary book of accounts? Why are we using the subsidiary book of account? Number one, to get the total sales and total purchases. Total sales in credit and also total purchases in credit. Then also they are used as a book to make first entry of transaction. They are used to make first entry of transaction. It can also be used for future references. Okay, the subsidiary books, let's list them. We have the first one there, which is Sales Daybook or Sales Journal. We have Purchase Daybook or Purchase Journal. Then we have the Sales Returns or Return Inward Journal. Then we have a Purchase Returns and Return Outward Journal. Then we have General Journal or Principal Journal. We can also call it a Journal proper. They have the cash book. Let's take them one after the other. Okay, Sales Daybook or Sales Journal. This is a book of original entry into which is recorded sales made on credit before posting to the ledger. That means all sales made to customer on credit must be recorded in the Sales Daybook before they are posted to the ledger. Please note, cash transaction must not be found there. Don't record cash transaction in the Sales Daybook. The Sales Daybook is always meant for credited sales. And also note, sales of fixed assets must not be recorded in the Sales Daybook. Sales of fixed assets must not be recorded in the Sales Daybook. Only sales of items which the company deals in should be recorded in the Sales Daybook. For instance, now the company has a car, and the selling of car is not the primary business of the company. So when the company sells the car, you are not supposed to enter it in the Sales Daybook because that is not the primary business of the company. That sales of fixed assets will be recorded in the general journal. We'll come to that. So the seller will enter the Sales Daybook from the sales invoice. Let's look at the sample of the Sales Daybook, how it looks like. We have date, particular, folio, detail, and total. Like I said earlier, total of Sales Daybook will be posted to the credit side of the sales account in the general ledger, and the personal account debited. That means the person you sold the goods to on credit account in your book will be debited. Then you credit your sales account. Please take note, sales account has to be credited. Sales account always have a credited balance. So let's consider trade discount. Trade discount is a percentage deduction from the selling price. Maybe like I said about the invoice. The invoice captures information like a quantity, the price, discount, trade discount, and terms of payment. If there's any discount given to the buyer, it will be stated in the trade, in the sales invoice, and to also be captured in the Sales Daybook. So let's take an example on this. Okay, let's take an example on a Sales Daybook. So enter the following transaction of Regulus Venture in the Sales Daybook for the month of November 2024 and post to the ledger. November 1st, 2024, sold goods to our on credit. 20 bags of garri at 300 naira each, 15 gallons of palm oil at 900 naira each. November 17, 2024, sold goods sold to HIF on credit, 200 bags of rice at 1000 naira each, then 150 gallons of groundnut oil at 500 naira each. Then there is a trade discount of 20%. That means the customer, that is the HIF, was giving 20% trade discount. So now let's solve the question. Enter the following transaction of Regulus Venture in the Sales Daybook for the month of November 2024 and post to the ledger. So now this is a credit transaction, as we have said before. So let's go to the daybook. This is already the book. I've already prepared it. The daybook already prepared. Just put Sales Daybook because it's a credit sales. Suppose it was a purchase, credit purchase, will have the purchase daybook. So Sales Daybook, let's have the first transaction here, which is on November 1st. You come in, enter 1st of November 2024. Then who did they sell the good to? It was sold to our. So the first transaction there was 20 bags of 20 bags of garri at 300 naira each. So we come here and write 20 times 300 is 6,000. Then the next one is 15 bags of 15 gallons of palm oil at 900 each. So here we come right 15 times 900 is 13,500. So this one is talking about sales. So here we put it's going to the sales ledger. So add these two together, 600 times 13,500, we have 19,500. So that is that for the first date on the first. So we go to the second one, which is November 17th November 2024. Who did you sell to? We sold to HIF. Yeah, it's 20 bags of rice at each. So multiply the two. That is 200,000 naira. So the second one is 150 gallons of groundnut oil at 500 naira each. Multiply the two, 150 times 500, which you have 75,000. So now the next item you have a trade discount. On the first, the sales to our was not given a trade discount, but HIF was given a trade discount. So let's add it together. 200 plus 75,000, we have 275,000. So now we need to subtract the discount given to HIF. Say less discount on the trade discount. Please note the life cycle of the trade discount ends in the daybook. The life cycle of trade discount ends in the daybook. So we have to say into bracket 20 over 100 times 275,000. Calculator to do this, it will give you 55,000 naira. So you subtract 55,000 from 275,000, you have 220,000 naira. This is the amount HFA is going to pay to Ogono's company. So now let's add this together. Since this is the last transaction here, we have 220 plus 19,500, we have 239,500. So here we say we transfer this balance, transfer to sales account. At the end of each period, we transfer the balance to the account, the respective account. So this is total going to sales account. Now I want to show you something. Before we transfer this sales daybook value to the ledger, let me show you something. So if you come to this place now, you see that on the first, goods sold to on credit, you can actually apply the entry principle right from that place. And I will tell you why sales book comes to play here. Sold to our on credit. Okay, if you say to our on credit, what are the two accounts affected? Sales and our. Why is our name coming up? It's because our is a vector to the company. So two accounts affected: sales account, open a sales account, then our account, accounts. So who is giving out, who is receiving? Definitely our is receiving because one buying the goods, our receiving the goods. So it's on the 1st of 11/2024, our receive narration of the sales, referencing sales. How much is it? Look at it. If you sum these two together, we give 19,500, 19,500. So the second leg of the whole entry principle, we come to sales in 1/11/2024. Then referencing our the one that bought on Reddit. However, the one that bought on credit. Then how much is this? Is 19,500. This is the double entry principle for the first day has been fulfilled. So the second one is sold to HIFA. So it's going to affect sales at HIFA. Already you have HIFA sales account here, so you need to open account for HIFA account. So HIFA is one receiving the goods. So capture the detail on the 17th of 11/2024. There was a sales to him, sales, referencing sales. How much is this? After removing discount, you have 220 to this value here. 220, if you do this, you have this 220 there. Then you go to sales account to fulfill the second part of the entry principle. You capture 17 of 11/2024. Here will be HIFA. Then there will be HIFA. Then the amount is 220. That is it. That is all. But where does this sales daybook come to play? Instead of you entering these two transactions, you don't need to enter these two transactions here. All you need to do is that just go to the summary, the sales daybook, which is 239,500. Just come here and type sundries, which is total of all the sales on credit for that period, 239,500. The month of November. That is that. So it must go through the sales daybook, which is sales daybook is all about recording alone. It's not posting. Then from there you move it to the sales account. And when you sales account, then you separate it. This 239,500. What are the elements that make up this amount? This is our funds 19,500 plus 220,000 naira of HIFA. Adding two together that give birth to this 239,500. So just a kind of a recap. I said trade discount life cycle ends in the daybook. Then the essence of the sales daybook is to capture all the credit sales for the period, then get the total amount, which is like this, that will be transferred to the to the sales account 23950, which is this amount, and I demonstrated how we arrive at this figure. That is all. If you have any question, please don't hesitate to drop it on the comment section. Let's call it a day here. So in our next session, we're going to be looking at other subsidiary books per account. For today, we will discuss the Sales Daybook, where we say all sales on credit must go through Sales Daybook. I've also said that sales of fixed assets should not go through the Sales Daybook. Such should not go through the Sales Daybook, and also cash sales should not go through the Sales Daybook. Please, just a reminder, if you know you have not subscribed to our YouTube channel, please kindly do so by clicking on the subscription button below. See you in the next section.